Good morning, dear friends. Today is Monday, 29th of September, and it's around 10 o'clock in the morning, so the European stock markets are open. My name is Clive Thompson. Today I'm covering everything which happened over the last week in terms of financial, stock market and economic news, as well as what's going on in the stock markets this morning. So today we'll be looking at Jerome Powell's balancing act with the interest rates last week, Mr. Trump's tariffs, the record-breaking gold price, a bold move by Tether, the stock market turbulence, and the risk of a US government shutdown. What does that mean? Along the way, I'll touch upon trade uncertainty, the dominance of passive investing, and the growing case for gold, or maybe Bitcoin. Let's have a look. So let's start with what happened when Jerome Powell spoke last week on Tuesday. This was his first speech since the September rate cut. And he confirmed many of the things we already know. The US economy is slowing. GDP growth fell to 1.5% in the first half, down from 2.5% last year. Unemployment was higher at 4.3%. Payroll increases, non-farm payrolls, have increased to just 29,000 a month, below the break-even rate. That's bad. Inflation is remaining sticky. The headline PCE inflation rate is 2.7% and the core inflation rate is 2.9%. Well below the target of 2%. And Powell told us what we already know again, that the tariffs will lift prices. He said that will take some quarters to work its way through the system, a bit every quarter. So we might have several quarters of rising prices, but he regards the effect of the tariffs as being temporary, not permanent. So the Federal Reserve cut the interest rates a couple of weeks ago to 25 basis points, so it's 4% to 4.25%, and Powell described that as modestly restrictive. But unlike what the markets were hoping for, he didn't give any signal that there'll be further rate cuts. He said that the policy is not on autopilot, meaning it's not going to keep going in the same direction. So the central bank is kind of walking a tightrope now between growth, which is clearly slowing if you look at the unemployment numbers, and inflation, which is clearly rising because of the rising inflation numbers. So the dilemma they're facing is, do they raise interest rates to try and rein in inflation? Well, the market's not expecting that at all. Or do they lower interest rates to try and encourage more employment? Because that's one of their mandates, to have full employment. The market's expecting 2 more cuts before Christmas. That's where we are at the moment. But who knows if that might change in some way. The Federal Reserve is being, in a way, led by the European Central Bank, which is cutting faster than the Federal Reserve due to weaker European European data. Now, there was a shock on Thursday relating to tariffs. It seems we get shocks all the time, but we'd had a little bit of a pause. So Thursday's shock was to do with branded pharmaceuticals. So President Trump said that starting on October the 1st, there will be a 100% tariff on branded pharmaceuticals entering the United States. However, he did say there would be exemptions for firms investing in the United States drug plants. So 2 large Swiss companies, Roche and Novartis, both said that they expect little impact thanks to their American build-outs. They're building factories in the United States. In his tariff announcement, he also hit trucks, cabinets, furniture, and obviously this is increasing the trade escalation, and trade uncertainty is now becoming more and more of a top issue, not just for stocks, but for bonds and currencies and countries around the world. people don't know where they're going to be next week. And if you're a manufacturer and you're manufacturing stuff for the United States, it's very difficult to know whether you'll even be able to sell it to the United States, because you don't know if there's going to be a tariff at any time without warning. One of the big stories last week was the huge surge in the price of precious metals. So gold literally surged last week. Let's have a look at that on the browser. Here we are. So you see the gold price literally shooting upwards. Let's make it a 1 month move here. Just have a look at the distance. So you see, last week we probably started the week, ended last week on the Friday at around 3,500. By midweek we were at 3,600, and then at the end of the week we were at 3,700. And today, this morning, it shot up again, another $44 up this morning, and we are at a whopping great $3,806. 3,805, 3,806 today. And gold is not alone. Other precious metals are following in its suit, or maybe they're leading sometimes. Now, just on gold, we've heard that there's been very strong inflows into the exchange-traded funds, the physically backed gold ETFs. Last week, the number of assets going in was an inflow of $5.6 billion US dollars. So what does that indicate? It indicates that maybe retail investors are starting to wake up a little bit, or maybe it's institutional investors, but someone out there is starting to add gold to their portfolios a little bit. And when the gold market, so what we're also seeing going with the gold market is the miners. The gold mining stocks are rising very rapidly too. Now, for most of the last few years, gold was rising, but the gold miners were really lagging. They weren't moving as much as gold. But this year, gold miners are moving faster than gold upwards, which is to be expected. So it's quite normal that there's a lag of maybe a couple of years, because between the time the gold price rises and the time that a gold miner can turn that into profits, it's going to be a lag of more than a year. It's going to be a year and a half or 2 years. So now those profits, as companies report their profits, they're reporting much higher profits than a year ago, and that is boosting their share prices. But next year, we're going to have even more of these boosts in profits, because the gold price is much higher than the average gold price at which they were selling their gold over the last 12 months. So they're reporting profits now, they're reporting the average gold price of the last 3 months or 6 months or 12 months, which was lower than today's price, which means that if today's price holds up, which I think it probably will, it means that the profits next year or next quarter, next half year, next year, and so on will be higher than they are today. So that's what's driving gold miners. And if we look at the GDX, which tracks the gold miners index, or tracks the gold miners, you can see it's been going up, go back to the end of August, and the price was around $63, give or take. It's now $74. So what does that tell us? It tells us that not only the gold miners ETF is rising, but the underlying stocks, the underlying gold miners are rising in price. So that's reflecting the fact that people expect them to sell their gold at a much higher price next year than they've been selling it recently. And if we go back and look at the year to date on the GDX, you can see it's had a absolutely massive rise so far this year, literally doubling from about 35 to over 70, well, now $74, over $70. What else is moving? Well, when gold moves, we also see all the precious metals complex moving. So looking at silver, that is priced at $46.68 at the moment. And I think at one point, it even this morning touched $37. Let's just have a quick look, see if we can see that. I'll look at the very short-term 5-day move, and $47. Yeah, you can see it did this morning, briefly, move over $47. It's coming off very sharply now. It's 46.67. But if you think about it, in a month, let's go back a month ago and see how far it's gone. It's gone a huge distance in a month. Here we are at the beginning of September. Beginning of September, it was at $39, and now it's $46. So that's $7 in a month. An incredible move. And we'll have a look at platinum, which is moving even faster. Platinum's up $17 today, up 1.09%. And platinum's at $1,603. And if we look just a few days ago, on the 23rd of September, it was $1,400. So $200 roughly of increase in the space of, well, what's that, 22nd to the 29th day in 1 week. So it's $200 in a week. That's just about 15% in a week it's up. Palladium isn't doing quite as well, but it's still rising. Here we have the palladium price. You can see that's gone from 1,150 to 1,291 in about a week. So let's see what's going on. I think we're starting to see more and more institutions notice that gold is one of the best performing assets this year, if not the best performing assets. And we saw that Morgan Stanley last week put out a note saying it's shifting its 60-40 model. The 60-40 model says you could have 60% equities and 40% bonds. They've shifted that to 60-20-20. So it's now 60 equities, 20 bonds, and guess what? 20 in gold. Now, wouldn't it be amazing if every institution in the world suddenly decided they wanted 20% in gold? That would be impossible. It's impossible for every investor to hold that much gold. But one institution can do it, and maybe one or two others might decide to do it. But I think what even if we get a very tiny move from the current 0.5% exposure to gold to, let's say, 2%, doesn't sound much. That would be 4 times as much gold held in portfolios, and it would be really transformative for the gold price if that were to happen. Now, if you're, why are Morgan Stanley making this move of 20% from bonds into gold? Well, simply speaking, we've got inflation coming, or that's what people think. And if you need protection, here's the message. Bonds are going to be the biggest victims of inflation, and gold is the hedge against inflation. So that kind of explains why money is moving into gold at the moment. What's going on in the crypto world? Well, we're seeing an interesting move by Tether. Tether is reportedly raising 15 to 20 billion based on a $500 billion valuation. The funds it gets will support expansion in stablecoins, artificial intelligence, commodities, and energies. So it looks like Tether is aiming to very much come into the mainstream, and if it does, with a public quote through the cash raise, I don't know if it's going to get a public quote, but certainly it's aiming to be one of the biggest financial companies in the world at 500 billion. Meanwhile, Bitcoin was about $112,000. Here's the chart of Bitcoin. You can see it in the browser now. Currently 111,986. It's having a bit of rebound. It had this large decline last week, down from $118,000 down to $109,000, and now it's bouncing back about 3,000. We don't know if that's a dead cat bounce or a resumption of the rally. We'll see. And Ethereum, which did dip below 3,900 this morning, or in fact even below 3,800, I think. No, 3,900 was the low point. It's now trading at 4,113. Again, a bit of a comeback. Is it a dead cat bounce, or is it a rally which has got legs? We'll see. How are equities doing? So let's start with the USA. Well, US stocks fell last week. Not a lot, a little. S&P, NASDAQ, Dow all ended lower. It wasn't very significant, it wasn't very big. And if we look at the charts of equities, which I'll bring up in a second, you'll see that the stock markets are really still, as near as makes no difference, at the all-time high. So here we are, you're looking at the Dow Jones, you see that little decline coming off last week, but it's still pretty close to the all-time high, especially if I bring up a 5-year chart, for example. There you are, that's better. The S&P 500 at 6643 looks like it's doing very well. It looks like a record, but you can see it just came off that little dip at the top there, came off last week, and NASDAQ had the same sort of pattern, slightly off the top last week, but ending the period at 24,503, up 105 points, or 0.44%. Elsewhere this morning in Europe, the FTSE is up 0.35%. You see it on the chart there. The German DAX index, the DAX index, is up 0.1%. The CAC current, CAC 40 in France, is up 0.05%. And the Swiss SMI index is up 0.52%. I'm surprised at that because with all the uncertainties regarding tariffs and pharmaceuticals, which do make up a certain percentage of the Swiss index, I'm surprised that prices are still going up. But let's turn to Asia, just see what Asia did. Asia, Nikkei in Japan slightly down, but it makes no difference to the all-time high. The Hong Kong index continues its recovery from 2024, up 1.9% today at 495.17. Let's just bring that up. There we are. That's the Hang Seng index at 26,623, up 495 points today, or 1.9%. VIX index, which is a measure of volatility, is still relatively low. It's at 15.77, which is particularly low. In stock moves, let's just have a look at Oracle. I'm going to bring that to a much shorter period. Let's bring that to 1 month. Have a look at Oracle. In Oracle, we had a week ago, 2 weeks ago, maybe around the 10th it was, a huge leap up in Oracle because it had announced a huge deal with OpenAI, where they're going to build some $300 billion of computing power. And that kind of grabbed the investors' attention. They said, oh, Oracle's now AI, and the share price rocketed up. Well, now some of that hype is going out of the markets, it's gone, and Oracle's share price has pulled back from over 340 to 286 at the moment. It's probably going to go up again, but it's certainly having a bit of a cooling down. Another stock in the news was Intel, where NVIDIA said it would buy $5 billion of Intel common stock. And another bit of news, NVIDIA, here's the NVIDIA chart, announced it would invest at least $100 billion into OpenAI, coupled with a commitment from OpenAI to purchase NVIDIA's chips. So if you think that sounds incestuous, I think it does too. So basically, NVIDIA's giving OpenAI $100 billion, and OpenAI is saying, thank you very much, we'll buy your chips as a quid pro quo. So it's a chip-backed investment. So it'll be interesting to see what happens. But obviously, if OpenAI then buy NVIDIA chips, and let's say they make 50% profit on each chip, that's 50 billion going into profits of NVIDIA at the end of the day. That's a real boost for the shareholders of NVIDIA. If of course the market accepts that the deals are real, because we don't know if OpenAI is going to order all these chips and then they'll sit in boxes for years unused and then one day it just gets sold on the secondary market. We don't know. But the bottom line is OpenAI is getting money from NVIDIA, which is going to give much of it back by purchasing their chips. Is it purchasing the chips because it needs them or because the deal forces them to do it? We don't know. So behind all of this, we're seeing a structural shift in the way investors are playing with the market. We're moving more and more into passive investing. Passive investing is dominating the markets. Exchange-traded funds are the way many investors are going. Their investment managers are putting their money into exchange-traded funds, which buy the whole market. And the market doesn't care whether the companies in the index are good or bad. They just buy all of them. So when you buy an ETF, it funnels the cash that you put into the ETF into the very same companies which are in the index that the ETF tracks, which if it's the S&P 500 or the NASDAQ 100, a lot of that money is going to flow into NVIDIA and companies like it in the Mag 7, the AI companies at the top of the pile. So that reduces efficiency, creates anomalies, and concentrates power in the top names. But eventually the pricing will normalize. But as for now, passive money is setting the tone as to where the money goes. So the European markets are opening up. Let's just have a quick look a little bit higher. We did have a look earlier, but I'm just interested to see how that goes. Let's go to the indices. Yeah, so you see all across the board, we're looking at 0.3%, 0.5%, depending on where you look. Hang Seng Index up, we saw that as well. Let's have a look at the European stocks a little bit. European equities are still trading at about 30% discount to their US peers. So European equities relative to US equities are relatively cheap. They were at 40% discount earlier in the year, but that gap has narrowed. But even after this rally, Europe still remains relatively cheap, at least compared with the USA. But if you're thinking of investing, remember, don't just buy the market. The trick is to find the opportunities in areas where other people are shying away. Don't be like the investment managers who don't make these bold calls. They try to stay in the middle of the pack. They try to minimize career risk. But if you step outside of that comfort zone and look around, you'll find stocks which look attractive but are overlooked by the market. But that's typically where the returns are. 10-year Treasury yields currently 4.2%, nothing special to say there. But we've got the ongoing rise in US government debt. That's putting pressure on the US dollar. The DXY hasn't changed much. It's at about 97.5. But let's look at sterling, which continues to slide. So let's go to currencies. I'll bring that up. So we'll start. Actually, I've got the DXY as the first one there. So that's your DXY. You can see it sliding in the last few days a little bit, not much. Come down from 98.5 to 97.90. Obviously, since the start of the year, it's been sliding. So I go to the year to date here, and you can see it slid from 108, 110 down to 97, about 10 or 11% off. Looking at the currencies, there's no big news except for the euro versus sterling. Sterling continues to fall compared with the euro. And there you see it on the chart, sort of straight down. Now, what about the US government shutdown risk? You've probably heard about it and don't know much about it. So I'm going to explain what's going on there. The US financial year runs until 30th of September each year. So that's coming up in a few days. Under the law, money cannot be spent without the approval of Congress. So the Constitution requires approval for all spending. So once we get past the 30th of September, unless they passed a variety of new bills, an extension to allow payments to continue, many government departments will have to shut down. They'll have to furlough staff. Only certain essentials will continue, like defence, law enforcement, social security. There's no automatic rollover where they can keep spending the money. So what does this mean? It means many government departments might close. Markets aren't going to like that. They don't like near-term volatility. They don't like a closed-down market. So if we get that, we might see further pressure from the credit rating agencies who might reduce the rating of the USA once again. Another bit of news from last week. China had a massive surplus in August. It was 102.3 billion trade surplus, up from 98 billion in July. So whilst exports are softening a little bit, there does seem to be ongoing trade, but the markets we'll see how this trade goes next month. So let's go back to the biggest move this day. We saw it earlier today, but I know you all want to know what the latest gold price is, and it is moving up. Economic data, let's go to gold. Yeah, so now it's moved up a bit more. It's now at $52.62 at $3,814. Meanwhile, silver's moved up again in the morning since I started speaking. It's up 86 cents now at $46.92, virtually at that $47 level, and clearly looks like it wants to go beyond the all-time high of $50 in the coming days. Platinum is 1605, above the 1,600 level. It's moved a lot in the last few days. You can see it's been rocketing up this morning. And palladium is 1,292. Thank you very much, ladies and gentlemen. Thanks for tuning in. And if you liked what I've got to say, please like, comment, and subscribe. I'll be happy to answer your comments if I can in the next few hours. I won't be able to answer them all, but I'll do my best to read them all. And I wish you all a great week. I will be trying to do some more of these in the coming week. So thanks very much, everybody, and see you soon. Bye-bye now.